This chapter deals with capital budgeting, and in this problem now they're going to give us a little practice on how to calculate book value. Book value would be something you want to know if you're going to calculate the tax consequences of a sale and things like that. Now, in the lecture I showed you how to do straight line depreciation. In this problem now we're going to learn how to do what's called Macrs, Modified Accelerated Cost Recovery System. And you're going to need to have the Macrs tables handy when we go through this. Now there should be one in your notes that go along with this chapter. There should also be one on the Blackboard site. So if you look on the left-hand side where the buttons are, you should find Macrs, and if you click on that, it'll lead you to a copy of the Macrs tables. Now, this particular problem that they give us to work here, this first problem, it reads, find the book value of each of the assets shown in the accompanying table, assuming that Macrs depreciation is used. And they give us the installed asset, the installed the installed cost of each of the assets. Now remember, installed cost now, that's the original depreciable value of the asset. They also tell us the recovery period. Now that's the Macrs recovery period. That's what the IRS has given us. They've told us that this type of asset should be depreciated over 3, 5, 7, or 10 years, and how much of it we can write off each year. They also tell us the elapsed time since the purchase. Remember, book value now, you have to calculate that at a specific time. Now, with Macrs now, unlike straight line depreciation, which is what we did during the lecture, with Macrs now, there is no salvage value allowed. So we would depreciate the entire value, the entire installed cost of the asset. And at the end of the day, when we get through depreciating with Macrs now, the book value of the asset would be 0. Okay? So just so you know, that's what we're going to be doing here. Now, this is a copy of the Macrs table, and this is what you should find in your notes. And you'll see here the recovery years, 3 years, 5 years, 7 years, and 10 years. And so the IRS will tell you which category your assets belong into. And under each recovery period, the percentages that you see there, they all add up to 100%. So that means after those number of years, you've depreciated 100% of the asset. Now, one of the things that students often ask about is, why is there an extra year? In other words, the 3-year life class, you really get 4 years of depreciation. The 5-year, you really get 6 years. That has to do with something called the half-life convention. Now, this is what the IRS uses so that you and I can't buy an asset in the current year and get all of the depreciation for the year. They make us wait a period of time to get the rest of the depreciation. So they moved off half the depreciation into a year later in time. And so with 3-year class life, this 7% that you see out here in the 4th year, they're going to make us wait to get the rest of that depreciation, that 7% out there. So you can't get the full depreciation in the first year, you have to wait. But this Macrs table now, you should have that handy, and we're going to work a problem out using Macrs instead of straight line depreciation. And this is the information they gave us in the textbook. They gave us the installed cost of the asset. Again, this is the original depreciable value of the asset. They tell us the recovery period. Now this is what the IRS really would tell us. Well, our asset, this first one's in the 5-year class life, and then a 3-year, 2 5 years, and then 1 7. So again, this is the Macrs tables, and this is the information that you would need to use it. This first asset has an installed cost of $950,000. It's in the 5-year recovery period, which would be this column right here on the Macrs table. And they tell us that 3 years have gone by. Now, you'll see that next column now reads cumulative Macrs. And indeed, if you go to the 5-year column and you add up the first 3 numbers there, that is 20%, 32%, and 19%, that all adds up to 71%, 0.71. So after 3 years, we've written off what? 71% of the installed cost of the asset. So if you take 71% of $950,000, you get the accumulated depreciation, which is $674,500. What's book value? Well, it's the original depreciable value of the asset, the installed cost, minus accumulated depreciation. So $950,000 minus $674,500 gives us a book value of $275,500 for asset A at the end of the third year. Asset B is a $40,000 asset. It's in the 3-year recovery period. We've owned it for a year. What's the cumulative MACRS? Well, that would be the first number under the 3-year life column, and that's 33%, 0.33. And again, 0.33 times 40,000 would be 13,200. That's the accumulated depreciation for this asset. What's book value? Well, it's the installed cost minus accumulated depreciation, which is 13,200. So the book value for asset B at the end of the first year, 26,800. Again, that's how you do all these different problems. I've given you all the answers and all the rest and explained to you how you work these problems. You should try this on your own, make sure you understand it. If you don't understand it, contact me and we'll work through whatever problems you have. But this is how you calculate book value using MACRS.